Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod. Sarah Friar, the CFO of OpenAI. Are we in an artificial intelligence bubble?
A lot of prognosticators want to call it like we're on the sugar rush. We're not. It's more like the railroads or the build out of electricity than anything I've seen.
Making the magic sauce for consumers of AI and waging an historic innovation debate.
We think AI is the biggest thing, the biggest era that we've seen to date, right? Those of us who've had the benefit of living through the internet era coming upon us, mobile era, AI is bigger than all of that.
An extended interview with one of 11 candidates for next Fed chair.
We're pulling for you so much, just so we can say David Zervos, Fed chair and CNBC contributor.
David Zervos on tariffs and getting back to 2019. The glory days? Well, at least for the Fed's balance sheet.
That was a neutral place. There were no rate hikes, no rate cuts priced in. We were sitting at a 2% yield curve flat. We had a balance sheet at 20% of GDP, no QE, no QT. It was about as neutral as it could get with the Fed at its mandate.
Those big interviews, plus Target has named a new CEO, and more chip makers might get in on a government deal.
Long term, most businesses that have now done business with the government would never do business with the government again.
That goes back hundreds of years.
It is Wednesday, August 20th. A supersized Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue it, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernen and Andrew Ross Sorkin.
Okay, big story this morning, which is this. The government now investigating taking possible equity stakes in computer chip companies that receive funding from the CHIPS Act that had been passed under former President Biden. A Reuters report saying that Commerce Secretary Howard Lutnick, who was on this network just yesterday, by the way, I thought he even might have hinted in this direction, looking into the idea for companies such as Micron, Taiwan Semiconductor, and Samsung effectively taking stakes in them. The report saying Lutnick has been pushing the equity idea. And the President Trump, of course, is a fan. The government has already been weighing different ways to get involved in Intel. Lutnick joined, as we just mentioned, Squawk on the Street yesterday, and here's what he told David Faber.
What is in it for the American taxpayer? And the answer Donald Trump has is we should get an equity stake for our money. So we'll deliver the money, which was already committed under the Biden administration. We'll get equity in return for it, get a good return for the American taxpayer instead of just giving grants away.
Shares of Intel gaining nearly 7% yesterday. The company's stock is up roughly 25% in August.
Scott Bessent said that to us.
About
Intel. He said, as long as we're giving them money, let's convert the grant into equity.
Right.
So
there's a couple of things that
the only thing
I
new
just
there
think
is
are
other than just Intel.
That is missing in the conversation. Originally, some of these companies likely would not have taken the grants if it was for equity. It wasn't like these companies were struggling. Intel was somewhat struggling at the time, but not super struggling.
No.
But they were being asked
in the 20s.
But they were being asked to build something that is otherwise uneconomical. Now, that was pre-tariff. So once you shift the dynamic where you have two things going on, you have Intel in a situation where it is demonstrably in trouble, and then you have the tariff piece on top, you've effectively changed the economic landscape so that actually saying, okay, you want this money to now do the business in the U.S., we can maybe try to force you to do something that you wouldn't have done otherwise. But the point that somehow this would have been, that like this was a mistake, that somehow a year ago or 2 years ago, the Biden administration could have said, hey, we want to give you this money and we're going to take an equity stake. I actually think most companies, especially TSMC, would have said, no, we don't want your equity.
If you remember at the time, it was put out as a plan because you had Germany and other European countries that were spending a lot of money to try and entice and enhance their packages for why companies would set up foundries there to go after it. So it was kind of going from that perspective. But I understand the argument that Lutnick
and I like what Bessent said. Just I don't immediately knee-jerk it that, oh, no, this is another negative thing. And it's if we're going to give money and give a grant, I think it's great to get a stake. Now, and then we can argue about too big to fail. We can argue about too big to fail, and the government doesn't know how to run things. But if you're going to get involved in the first place, you might as well get something.
All I'm
out of it.
suggesting is you could have never gotten it the first time.
Right, but,
Well, then it's
but you're
even
right
better
that the
for-
landscape
for-
has changed.
for
Well, but the
taxpayers.
landscape has changed because the government has changed. So I just want everyone to understand what's happened, because I think what
They
happens
wouldn't
is
have
some of the politicians come on the air and say, well, it was somehow a mistake
they
before to
have
have
to-
given the grant, and that somehow we didn't get these equity stakes. Well, the whole world is different, because the reason why they would now maybe even go along with this is because it's because of tariffs that would otherwise make it too expensive to do the business outside the United States.
All it is a carrot versus a stick. Now we're talking about a stick. You're either going to do this or you're going to suffer. Before it was a carrot. Come here and do your business here, and maybe we'll pay you to
Correct.
do it. Now it's a stick situation.
Which then raises a whole other question, which is long term. And look, Jamie Dimon's already made the comment. Long term, most businesses that have now done business with the government would never do business with the government again.
That goes
Well, that
back
goes with the
hundreds.
banks.
That goes back hundreds of years.
But it goes back to Jamie's personal experience, where he
Yes,
got forced to things.
but that's
crammed
my
down
It's
his
never-
throats,
I mean,
2007,
But that's my
2008.
point. My point is that what's going to happen over and over again is the more and more we get into this super duper industrial policy situation, the next time the government, unless it's all by stick, if we have all moved into it's not carrot, it's all stick. If the government is now just a stick for every company.
I mean, it's a stick.
By the way,
if you
then
want
you don't want to do business in the U.S.
No, but it's a stick if you want access to this market. We happen to have 330 million very wealthy consumers relative to the rest of the world.
I think it's a lesser of two evils. I think that the two wrongs don't make a right. But when you started this with the CHIPS Act, where we'll give you this money, you hire union people, do DEI. If you don't have your DEIs in order, we're not going to give you this grant. If you don't
I'm not saying it was.
That's
it
what I mean.
was
So
given out properly.
that was the original problem with the way that was set up. This is also probably not perfect, but I think it's an uptick, a step up from the way I'd rather have the equity stake than have mandatory child
By the
care.
way, as a taxpayer, I'd prefer to have the
Well, there
equity
you
stake.
go.
No
then.
question.
Are you not paying taxes anymore? You're pretty.
I'm proudly paying my taxes. I'll proudly pay my taxes.
Okay.
I always tell you, the more you make, the more you pay, the better it is.
Yeah.
The better it is.
You're not using that bottom line that much, but where you can pay more.
The better it is.
You take all your deductions.
The point that I'm making is that the perception that somehow the original deal, which by the way has its own problems, but the idea that like you could have got an equity then is impossible.
I prefer this to the original setup. I'd rather have it this way. And Lutnick is, I don't think of him as a industrial policy, state-sponsored, socialist type individual. I mean, he is a capitalist through and through. So, I mean, I just don't immediately knee-jerk it as something that you need to criticize as bad.
I didn't criticize it. I just said to you that it's just different than what it's been portrayed as. I just like when they tell it to you straight. That's all I'm saying.
And what would they say if they told it to you straight?
They would say that we gave them money in the past under circumstances where we were trying to bring them into our country. We were trying to bring them in. They would not have taken the money under other circumstances at the time. We changed the playing field in the middle of the game.
Because of tariffs?
Because of tariffs. Because we said that it would be too expensive for you to do this in another country. That's why you wouldn't have. The reason why nobody wanted to make the chips here before was because it was economical to do them outside of the country, not economical to do them here.
Yeah, but it is this administration that changed that to make it so they can.
I'm saying they changed that, but then you can't stand there and say, they should have done they should have done the equity the first time.
Yeah. You can stand there and say that because
then you're lying.
Look, I don't know how I feel about some of the tariffs, but if they're the ones who put the tariffs in, who made it uneconomical to make things overseas and import them here, to say, hey.
I'm just saying you need to have the full context to understand what's actually happened here.
I just think it's a different set of incentives, carrot versus stick. I mean.
We'd have to, when we talk, I mean, not all industrial policy is created equal. And this is...
No, but you're not a fan of much of anything.
No, I'm not. But it's a lesser of two evils. I'd rather have a stake than just give them a grant based on, whether they do their DEI hiring properly. And it's got to be all union workers. It's like the two parties have different priorities. And I guess someone in the middle wouldn't like either. The White House launching an official TikTok account under the @WhiteHouse handle. The account went live last night. Its first video shows footage of President Trump as he says I am your voice. TikTok boasts 170 million users in the U.S., and it's owned by a Chinese company called ByteDance. A 2024 law required the app to stop operating in the U.S. By early this year, unless ByteDance divested its U.S. Assets. But a couple of times, President Trump has opted not to enforce that law and has extended the divestment headline.
Can we just talk about this for 1 second? Because this is another example of just the public being totally snowed.
Right.
And I've been saying this for years. Either it's a national security risk or it's not. This is as evidence as anything that it is not. It is as evidence as anything that for the last year, if Congress really thought, if the American public really thought that TikTok was somehow some kind of genuine national security risk, do you think the White House would create an account?
It could be somewhere in between. It could be economically, we're going to do it, and we're going to just overlook the possibility that it's a security issue. It still could be, but it's just too important. It's the same thing with selling those chips to the advanced chips to China.
But we created
not great.
We created a whole law. But we had people come on this program. We had people go all over the airwaves around the country screaming and hollering that this was a national security risk.
Those people will still say that.
They
think that Trump is just doing the wrong thing.
They actually created the law.
Yeah.
It's in effect. This has now gone on for a year.
I was hoping.
They will say the same thing. The president has decided that the economic importance importance of this. And
I understand that. And Andrew, I'm just suggesting to you that I believe that we've been snowed on this.
Yeah, but when I look at
snowed.
No.
Snowed now or snowed then?
We were snowed then.
When you look at the current state of the youth in this country, of the youths, that's from my cousin Vinny. When you look at the current state, I'd like to be able to blame something, and TikTok is an easy target.
Sure.
Otherwise, it's just us and social media, and we got no excuse for what we
Fine, but then you can't run around with your hair on fire claiming that the world is going to come to an end if this app is allowed to operate in the United States.
Right.
And now you have the White House operating.
With a different view. It's a different administration with a different view. And Donald Trump, and by the way, the write-ups on this say
where are all of the Republican congressmen, the Republican senators?
They're afraid.
I thought it was more Democrats
standing up, or the Democrats standing up.
Well, why do you pick Republicans immediately?
Well, because actually a lot of them were on this. Remember the Select Committee?
Yeah.
Okay, who started the Select Committee?
I don't know. I've never been on TikTok. I don't go on TikTok.
No. The Select Committee was not part of TikTok.
No, I'm saying
I don't.
The whole issue is kind of moot to me because I don't know what goes on that thing. Is it what's OnlyFans? I'm worried about that too. Is that on?
My God.
Some breaking news for you this morning from Target. The company is announcing a big change. The longtime CEO, Brian Cornell, is going to be leaving the top job as of February 1st of next year, and he will become the executive chair of the board of directors. He's going to be replaced as CEO by Target's chief operating officer, Michael Fidelki, who was elected unanimously by the board. Now, this news does come as Target reports its second quarter results this morning. If you're looking at those numbers, earnings and revenue both beating the street's expectations. Earnings per share came in at $2.05 a share. That was better than the $2.03 the street was expecting. Revenue came in at $25.21 billion, and that was slightly better than the $24.93 billion consensus on that. Comp store sales were down for the second quarter. They were down by 1.9%, but that wasn't as bad as the 3% drop the street had been expecting. If you're looking at the stock right now, it's off by about 1.25%, make that 3% in the knee-jerk reaction.
11th straight quarter of flat or falling sales.
The bigger problem that they have is they have 6 months in a row of declining traffic coming into the company too, and that's been a big issue. I did get the chance to speak to both Brian Cornell and the COO, Michael Fidelki, about this. They say they're encouraged by the progress that was made in the second quarter, but they also both admit they have a lot of work to do when it comes to this. If you look over long-term stock charts, you can see what's happened with this. Year to date, that stock is now down by about 27%. If you were to compare that to the S&P 500, it's up by better than 10%. And if you look at Walmart, particularly at some of the longer-term charts on this, you're going to see some big...
Look at the stock today now. I mean, you would think that a new management change, a lot of times the stock goes up. It's down $9. That's how bad the results are again.
The results are a little better than expected, but I think overall they're not showing the progress that needs to be shown.
The stock's down 60% from its high.
From its all-time high. Let's just take a look. He came in August 12th of 2014. So he's been there 11 years. Over that period of time, Target shares are up by about 80%. But if you were to just put your money in the S&P 500 over that period of time, I think it'd be up by about 230%. If you had invested in Walmart, I think it'd be up by about 310%.
We need longer-term charts
than
what we're showing right there.
If you go back to when he first started, you're looking at just straight on his
or even from the high.
No, I know, but just on
right,
from
80%.
The day
he started in 2014 to where we are now versus this. But if you go back, hopefully we can see. Oh, there's a comparison chart, but
for the three.
The three, and then if you just look at a 5, you can see on a 5-year chart how high Target was cranking right after the.
It was
after the
pandemic.
After the pandemic.
But they have struggled in a lot of ways. The first was they got in trouble with inventories being too heavily stocked when things slowed down after the pandemic. And then they've had a lot of issues. I did ask them specifically if they thought the reason for the traffic slowdown was because of what they've seen with the protests, both the woke and anti-woke protests that have gone off in different sides. They've had both sides that have come to them and protested on these issues. And then other people say if it's not that, it's just retail basics that they've fallen behind on some of these issues. Both of them say that there's a lot of work that needs to be done and that they've been disappointed over by what they've seen over the last 3 years as well.
Yeah.
Look, they do have two different things that are going on. They're trying to maintain prices in the face of tariffs that they are hit a little harder by based on where their sourcing is and based on just the idea that there's more fashion items.
If you got problems, if you've got organic problems with the company and then you get that
external problems,
all that stuff,
that kind of come into
all that noise, and it was loud.
At
it was loud
first
noise.
It was conservatives who were upset and were boycotting, and then when they had some success with getting some of the pride things taken out of the store, when they had some rollbacks of the DEI movements, then you had the other side getting upset.
That's the narrative, but it's the same with Bud Light. They actually said that it's not that the overall population stopped drinking Bud Light. It's that when they folded to the pressure that all the people that are pro whatever that commercial was, that they stopped. And that's got to be a lot less than just the overall population.
Yeah, look, traffic has been an issue there. They say that what they're going to do is try and maintain prices, but that could put a threat to operating margins. Now, their operating margins are down from what they were a year ago, a little better than the street had been anticipating. But right now, it looks like they are eating some of the tariff increases themselves to try and help bring traffic back through.
What do we know about Fidelki? He's a long-time employee,
He's been there for
right?
more than 20 years. He started out as an intern between his first and second year in business school at Kellogg. He has done just about everything.
Probably
there.
young if he.
He is relatively young. He
in his 40s.
I don't know if he's in his 40s, but 50 at the most. Yeah,
okay.
but he is at least 15 years younger than Brian Cornell. He was an engineer at Iowa. Then he went to the Kellogg School of Business. He's done HR there. He's worked in stores. He has worked just about every department of the business, and he has most recently been in charge of trying to look for overall initiatives to bring down prices and to try and maintain efficiency at the company as well. Said he fell in love with Target after his first year of being there, and that's why he stuck around and stayed. But again, you see the street's reaction to this. Stock is off by about 8.5%.
That's weird.
Yeah.
All right.
Again, what they're going to do is trying to maintain costs so that consumers will continue to come in. But then I asked them both, what does that mean for investors? The message here, are those margins going to get squeezed and compressed on this? They said, look, we're still reaffirming our guidance for the full year, for the rest of the year. And so they think that that would be a message to investors that they hope will offer them some reassurance. But again, you see the reaction in the stock this morning.
Cheese will be next.
Coming up on Squawk Pod, CFO of OpenAI, Friar. Years of experience in tech, and now she's a key player in the AI revolution with the company's CEO, Sam Altman. How ChatGPT is growing.
People are very opinionated. They've come to love their ChatGPT.
And took a major foothold in AI's race for dominance in search. Forget Google.
So I think we're really underestimating how much bigger search is becoming, but how much share we're taking.
You do not want to miss this interview. It's right after a short break. This is Squawk Pod.
Up and Becky, Q.
You're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernen and Andrew Ross Sorkin.
Joining us right now, though, at the table, an exclusive interview with OpenAI's CFO, Sarah Friar, at the table. It's nice to see you.
Great to see you,
we
Andrew.
talked to Sam just about 2 weeks ago now when ChatGPT 5 launched.
One of the biggest things, though, is it's an integrated single experience. We have built a system that can answer easy questions quickly. It can think for a long time and answer hard questions. And it's there's just one thing called GPT-5 now instead of the long list of models we used to have. It's much better for businesses and enterprises. The coding in particular is something that people have been really waiting for a great model for. So we're seeing super strong enterprise adoption of this.
There was a little bit of consternation in the week since about sort of what is going on with the model, some shifts in the model. I will say that it seems like it's gotten a little bit better from some of the problems that first emerged right out of the gate. Have you been experiencing this?
So, I think with any launch, when you have 700 million weekly active users, you start to find people are very opinionated. They've come to love their ChatGPT. And frankly, as we've released things like memory, it's become more and more your ChatGPT. But as we've come out of the gate, we're seeing actually acceleration in Plus and Pro subscriptions. That's a good sign. People are seeing a lot of value. And we're seeing really nice momentum in the enterprise, great momentum with developers.
Well, that's where I was going to go. Coding and developers. Some people have tried to describe this as an anthropic killer. Mm-hmm. And so I want to understand what you think has happened in the last week. I know Cursor's obviously taken this on and it's made it its default.
Yes.
But what are you hearing and what kind of reaction are you getting from the coding community?
So developer outcome was actually great. I think our numbers were up something like 50% just week over week on the number of tokens and so on being used. What we see is tokens in particular for agentic behavior and so on almost doubled. Reasoning, which is what I get really excited about because that's a place where I think we've really extended our lead, was up 8x in terms of usage of the reasoning components of the model.
Okay, so tell me about this.
Motion.
Sam has a dinner, I believe out in San Francisco.
He does.
And he says at the dinner, though, this is the famous dinner in the last week, where he says that there could be an AI bubble that's taking place. Do you believe there's an AI bubble? And I say that in the context that there's apparently a secondary sale of some of your private stock that some of your employees may be trying to sell at a $500 billion valuation.
So first of all, I think what Sam said and what I fully agree with is we think AI is the biggest thing, the biggest era that we've seen to date, right? Those of us who've had the benefit of living through the internet era coming upon us, mobile era, AI is bigger than all of that. And I don't think any of that is slowing down. If you look at infrastructure builds and so on, which you all care about, those stocks. In terms of can there be moments where people invest in things that don't come to fruition? Absolutely. Happens in every era. And I think that's what Sam was saying, is that there will probably be investments made that are not the best of investments, but we still feel like the AI era is upon us and that we're leading the pack on that front.
Let me ask you something, actually. As somebody who thinks about that, there's a lot of people who are trying to create startups, AI-related startups, and just other startups. And what kind of moat anybody is going to have around any kind of business in the future, given that arguably, if this works as well as it's supposed to, I should be able to build anybody else's company and break through tomorrow.
Yeah. So I think a couple of things. When I talk to VCs in particular, I always ask this question because they're thinking about their portfolio. And so what I look for in an investment around AI right now is, number one, are you solving a real problem? It sounds really trite, but sometimes I think people try to solve problems that don't really exist in the world. Second, is there a true business process that's quite complicated? I think in a lot of cases, people are looking for the shiny, bright object, but there's a lot of just hardcore, like in my world, like finance, that now can be done agentically with really complex business processes. And then do you have access to data that is unique? I think the stat is something like, it's a good ChatGPT question, 90+% of the world's data sits behind closed doors. It sits in university settings and company settings and so on. And so can you access that in an appropriate way? That's what I think builds competitive moat. But I do think that we're moving into this world, I call it of abundance, where you're right. Like if I want planning software as a finance person, I don't need to go buy off the shelf anymore. I can build internally the best planning software for OpenAI. Now we still work though with companies like Salesforce. For example, you asked about GPT-5. They were one of our real reference customers. They're using it for Agentforce. And so it's a good example where even the world of enterprise software, they're grabbing hold of this, and I think the leaders will lead by continuing to deploy it.
Let me ask you a data question, because people have also talked about if you have the data, that can be a super valuable component part. I had long thought that Google should be the winner of this whole ball game, because it has my email, it has my calendar going back almost 2 decades practically, right? I mean, it's unbelievable. And yet, one of the things that's happened even in the last couple months now is you, ChatGPT, and by the way, Anthropic and others, can effectively port in to that same data stream. Now, so there's 2 questions. One is, should Google be allowing anybody to port into that data stream? That's what the customers are demanding, so they think they need to do it. I don't know if you would do it. And B, if that's the case, it may very well be that this idea that data is the sort of gating factor. Data will always be the gating factor, but it may be that those who have the data are going to have to open it up to everybody.
Yeah, look, I think when customers say it's not Google's data and it's not, any software data, it's my data, right? This is what I've done with my employees, with my customers, and so on. So we've all built connectors in. It's actually been one of the reasons the enterprise business has been so strong. If you look at our business in the last 6 months, what's really outperformed, ChatGPT has been amazing on the consumer side, but what's really outperformed what I see is enterprise and API. And that's connectors happening. Because again, as people come to work, they expect to be able to do an enterprise search and for it to be able to go look inside of my Slack and my email and my calendar and so on. So it's making it incredibly valuable. And then as we look forward, I think what you're starting to see is memory getting overlaid on top of that. It starts to really understand who I am, both as a professional or as an individual, and you connect that data to what I am and how I like to search. It's blowing open the search market. I think we've gone from something like 6% share overall to 12% in 6 months. And I think that underestimates, by the way, because when you are doing a conversational search in ChatGPT, you probably go back and forth 5, 6 times. That doesn't count as 5, 6 searches, which is what Google would count as. Counts as 1. So I think we're really underestimating how much bigger search is becoming, but how much share we're taking.
Can I ask you a big sort of economic question? And we were talking about the Fed and how the economy is going and everything else. And one of the things that's happening is whatever you think is happening with tariffs and everything else, the economy is absorbing a lot. In large part, I would argue, because of the AI boom, the amount of money that some of the big companies, Microsoft, Google, and others, and yourselves are spending on CapEx, and it trickles into the economy in so many ways, whether it's in construction or electricity or engineering or energy or real estate, all of it. This either gold rush, it's either a gold rush or a sugar rush. And how long you think that build out really lasts? Because it may take several hundred people to build a data center, but it only takes 5 or 10 to operate it.
I think we are so in the early inning. I think a lot of prognosticators want to call it like we're on the sugar rush. We're not. It's more like the railroads or the build out of electricity than anything I've seen. The internet, it turns out in hindsight, was actually a relatively CapEx light build out. And so I think we are just getting started. Now we have to do a lot to figure out how to make data centers more efficient, to think about new ways to power them. But in terms of AI, it is voracious right now for GPUs and for compute. The biggest thing we face is being constantly under compute. That's why we launched Stargate. That's why we're doing the bigger builds, as you see, with Microsoft, but with Oracle, CoreWeave, and so on. And we're just getting started.
How reliant are you on Microsoft? And if that partnership is not as strong going forward as it has been to this point, what does that mean? They've provided a lot of the money and the power for doing these things. Can you do it on your own without them at this point?
Our relationship is changing because we've gotten so much bigger, right? Today, if you look at the scale, right, after ChatGPT launched, we did $1 billion of revenue in the first year. Took us another year to do $1.25 billion. We just did our first $1 billion month last month. Wow. So the scale is massive. And so, as with anything, we now need multiple suppliers. So Microsoft is really important from a compute perspective, but now we're getting compute supply from many, many vendors across the spectrum. And I think that's good for both getting it, because we're compute constrained, but also risk management. But Microsoft will be an important partner for years to come. And I think we're very intertwined because of our IP. Remember, Microsoft's AI products are built on OpenAI technology.
Two things. What do you make of people who are trying to play effectively owning your stock via owning Microsoft or owning SoftBank? I mean, that seems to be this sort of, there's like a bank shot situation since you're a private company.
Yep.
What do you think of that? And also, by the way, throw in there, what do you think of folks who are trying to, quote unquote, tokenize your shares and sort of work around some of the accredited investor rules, even in the United States, to sell your shares to folks who I don't think are on your list of, on your cap table, officially at least?
So first of all, it's great to see the investor interest, and it's a privilege to get to work with some of the best investors in the world. Like the round we just closed was 5x oversubscribed. So there's tons of demand. I think investors want direct investment ability into the model companies or directly into AI. Because you're right, today they have to do it via the larger hyperscalers, and so you're getting a little bit of everything. You're getting some access to AI, but they also have incumbent businesses that could be really disrupted. SoftBank, Masa-san, you have to give a ton of credit to just his vision for AI, both through OpenAI, but also through plays like ARM. I think on the Microsoft front, investing in us through Microsoft, probably a little bit of like a multi-step process that I wouldn't opine on, not an analyst these days. But I think our business is just going from strength to strength, and more people are going to want to have access.
What do you think of this tokenization situation?
I think we are very mindful of making sure we keep a sound control of our cap table, because as you know, it can become pretty complex fast. And so we have very strict transfer restrictions on it. So we try to stay away from too much complexity.
But so when you saw Robinhood selling
work.
your shares effectively, or selling a derivative of them?
I mean, we love that there's so much interest, but we want to make sure we're working with our investors the right way.
Is there any reason for you to go public anytime, or do you just not need it because there's so many people who want to get into anything you offer up?
I think it comes back to the strength of the business and then our mission statement, right? We always say we are here to build AGI for the benefit of all of humanity, for people everywhere. And part of what I like about a public offering is it democratizes who has access to owning and partaking in that upside. But I think right now we're proving we can raise capital at massive scale without being a public company. We can attract, retain employees without being a public company. So I think at some point in our future, for sure, we will look at it. But I think right now we're eyes on keeping the business momentum up.
But it's not in the next year.
Focus on the business first. Ultimately, the market stuff will work if your business is strong.
Let me ask you one more. This morning, news reports that the U.S. government may want to take stakes in the semiconductor companies that received money via the CHIPS Act. What do you think of that?
So I think it underscores, number one, how important that AI infrastructure build is. So what we just talked about, right? This is a place that you're going to need a lot of capital coming to the table, including sovereigns. One of the things that amazed me about OpenAI is how many governments come to us to say, we want to roll out your products in our country. So Norway is the most recent example. I think the second thing is it's becoming more than just an infrastructure play. People are seeing it as part of being a national asset, effectively being a national security play. And so our goal is to make sure our AI, kind of AI that has a democratic element or a completely built on democratic AI, is launched globally.
What do you think of the carrot stick idea? Meaning the original CHIPS Act was a carrot. Come do something that actually historically wasn't economic.
Do you view it as a public-private partnership? But wait, Democrats love that until a Republican administration does it, and then they hate it.
I think it is really important that the U.S. government is saying AI is an incredible part of our future.
But is this okay to do it this way with industrial policy? With industrial policy, are you okay with that? I think that's the question.
What I want to see is that we can get the scale of investment going that we believe is going to be required for our business.
And you'd be okay with the government picking winners and losers.
Sitting in my seat, I am short compute. But the only thing I know for certainty is zero compute, zero revenue.
Here's my question to you.
It could be down.
No, here's my question to you. When the President of the United States calls you up on the phone and says, look, you know what? You're using Taiwan Semiconductor chips. We're subsidizing them, which guess what? Means we're subsidizing you. And guess what? We want a stake in your company, and you're just going to give it to us because that's the way this is all going to go down. What are you going to say then? That is actually the question.
I mean, I'm going to go back to what I can say, which is I want to make sure we have vast quantities of compute as a company, but importantly as a nation. I think it is that important for folks looking forward in terms of what this technology does in healthcare, in education, just across every vertical.
That sounds like it's one of those, it's different this time and it's okay. Doesn't it? It kind of sounds like that, and it might be. It might be. After what we saw where we didn't have really important things because of our supply chains.
National defense perspective.
For national defense and for what we're doing with AI. And then
I'm just surprised because most of the time you would say slippery slope, because I just gave you the slippery slope example.
And most of the time you would say, oh, public-private partnerships, the government's great with chips. We're both wearing different, we've switched back and forth on a daily basis on what we...
Because you asked me, like, is this, is the bubble over, is it sugar high or whatever? And I just told you that it's just at the beginning. And the amount of capital required is like the railways. It's like electricity. And so it's not, I don't think it can only be private sector. I think
but then it becomes like a utility. But then it becomes like a utility and becomes a highly regulated business.
And we could also keep Intel alive.
It doesn't necessarily
when
have to become utility is highly regulated. That's not a line of thinking.
But historically, that's what's happened. When you take government money, they become highly regulated businesses. That's usually the social compact.
And they don't fail. They're not allowed to fail. And failure is just as important as success in capitalism.
But is OpenAI going to
in the end, I think you focus on your business, you get your business going.
This is like
you
a great
grow at the pace we're growing at.
Conversation.
She came on to talk about like OpenAI.
Yeah.
Sarah Friar,
thank you.
CFO of OpenAI. Thank you for playing along.
She just asked ChatGPT, is industrial policy okay? And what's the answer?
That is a very good deep research report, Joe. You should do that.
We loved having you on the broadcast this morning. Thank you.
So good to see you all.
You bet.
Still to come on Squawk Pod, a contender for the next chair of the Federal Reserve, David Zervos, also a CNBC contributor, and he says the ideal Fed balance sheet, that was in 2019.
The balance sheet of the Fed has now contracted to the point of almost being neutral after being very stimulative for a very long time. And so you're left now with rates at a much more restrictive rate without that extra kicker from the balance sheet. And so we really need to get rates back toward a more neutral level.
We'll be right back. Welcome back to Squawk Pod. I'm producer Katie Kramer. We've been following for months the road to a new chair of the U.S. Federal Reserve between President Trump's many jabs at sitting chair Jay Powell, whose term does expire in May.
I think he's done a bad job, but he's going to be out pretty soon anyway. In eight months, he'll be out.
And the president's interest in other candidates for the job, including two he named on our show, former Fed Governor Kevin Warsh and economic advisor Kevin Hassett.
I say Kevin and Kevin. Both Kevins are very good.
And even like sitting Treasury Secretary Scott Bessent.
I love Scott, but he wants to stay where he is. I'll take him off because I asked him just last night, is this something you want? Nope, I want to stay where I am.
Many of those potentials have come on Squawk Box to toss their hats into the ring, make their case. There are currently 11 candidates, and each one, along with Wall Street, is awaiting a speech from Jerome Powell this Friday. At the annual Jackson Hole Symposium, central bank officials from around the world give remarks about interest rates, inflation, and the state of our economies. Historically, the remarks by the sitting U.S. Fed chair have signaled monetary policy and have moved the markets. We are still 2 days away from Jay Powell's speech, likely among the last comments he makes before a successor becomes official. Let's get back to Joe, Becky, and Andrew. Here's Andrew.
Let's talk markets, Fed, interest rates, inflation, and so much more with a guy who you probably need to know even better than you may already. David Zervos is here. He's chief market strategist at Jefferies, CNBC contributor. And yes, now he is officially on the list of candidates being considered for the job of Fed chairman. So good morning. Now do you have to watch your words in a different way, do you feel like?
I think that's probably fair to say. I would also say that, I kind of have to come at this a little bit differently than I've done in the past, where I talk more about what I think the Fed should do as opposed to what I've done for the last 15 years, which is at Jefferies and even before that, which is talk about what the Fed will do. So I'm here to talk about a much more broader set of topics.
Before we get into any of that, though, just tell us, the backstory on getting on this list, what kind of phone calls you've got, and I know that you have a relationship and you've known the Treasury Secretary for a long time.
I have. I've known Scott for quite a while. He's a wonderful guy and an amazing. He's transitioned into an amazing Treasury Secretary, but he's an amazing trader as well. And so I've known Scott. I've met the president a few times, and I've been involved with a few other folks that are part of the administration and were part of the campaign as well. So I sort of got myself closer to Washington in the last couple of years. And
we're pulling for you so much, just so we can say David Zervos, Fed Chair and CNBC contributor. Would you give that up?
I would, if I have to, I would. I wouldn't. If they tell me, they're going to make you give up a lot of things.
That's something to think about before you accept. Can you imagine? I was kidding about pulling for you. We're pulling for everybody.
We're other CNBC contributors that have been on Fed chair lists in the past.
I don't think so.
I don't know. Well, that's a guess, but I don't know.
Although I did
not a contributor.
I think the president, when he called in, he did talk about how CNBC was fertile ground for potential Fed chair.
He did
as well.
There you are.
And
there used to be Trump Tuesdays.
So here's the big question.
Yeah.
What would you do? What would you do? Now, what do you think they will do or should do? What would you do?
I mean, what I would do is try to coalesce the committee around the idea that policy is actually quite restrictive. I think that argument needs to be made, and that argument is something I've been making in my research notes and in my analysis now for the better part of 8 to 9 months, basically going back into the basically the fall of last year. And the idea, it's a little bit wonky, but Kevin Warsh has been kind of pushing on this idea, a good friend as well, that the balance sheet of the Fed has now contracted to the point of almost being neutral after being very stimulative for a very long time. And so you're left now with rates at a much more restrictive rate without that extra kicker from the balance sheet. And so we really need to get rates back toward a more neutral level.
So it's not a Fed funds versus 10-year.
It's much more about the combination of the balance sheet and the rate structure. And I think someone needs to go in and argue and present with the 11 other voting members on that committee a cogent case for why rates are more restrictive than maybe the Fed is currently thinking, the staff is currently thinking, and the street economists are currently thinking.
Can I ask you, and maybe this is like a deep sort of, like dark arts of what's happening here, but a number of people that I've talked to that are living in the realm that you're living in are all trying to see what Jay Powell either says on Friday in Jackson Hole, but maybe even more importantly does in September, because that will be probably the last major decision he will make before somebody gets named. And the reason I mention this is there is a view, I don't know if you agree with this view, that if he doesn't cut rates in September, the president, first of all, will think that Jay is thumbing his nose at him, but B, would want to find somebody who is super dovish, somebody who he knows he could be put in there who would get the job done effectively. But if he lowers rates, that maybe it somehow takes a little bit of the pressure off in terms of the kind of person he might select. Am I reading tea leaves too much?
That seems a little deep in the weeds for me. I think the idea of this meeting being such a critical meeting is probably, I wouldn't go there. I just wouldn't go there. I would argue that this meeting is an important meeting, but the importance of what Jay says on forward guidance or what the committee is doing in these set of meetings leading up to a pretty significant leadership change at the board are less and less significant. In fact, it's becoming more irrelevant. We're going to have a committee by May of next year that's made up of 4 Trump nominees. It's going to be Michelle Bowman and Chris Waller, who were already picked by the president, then the seat for Adriana Kugler, and the seat that Jay vacates in May. So you're going to have 4 out of 7 board members that are effectively.
That's some of the news I'm seeing today.
What's that?
That's maybe another one with some of the news that's out today about some others. Santelli's on this, but we'll talk about that maybe a little bit later. But my wonky question is, how does the balance sheet that you described get you to the risk being much more on growth than inflation? Why do you think that the nature of what you described with the balance sheet is, why do you think that inflation is not a problem when it seems so sticky to get down to 2 for the last mile?
I think it's been a little sticky. It's come a long way, Joe. It's come from 9.1 down to 2 and change.
But if you want 2, we're not 2. We're headed back above 3. It could be, right?
This is the art of central banking, right? You're balancing a 4.2% unemployment rate with a 2 and change inflation rate. You're looking at the future and saying, what are the inflationary pressures? We've got demographics, we've got AI.
1 to 3 is good enough for government work, is what you're saying. 1 to 3 is good enough.
Maybe when you start working for the government, you get 8-foot gimmies instead of 2-foot gimmies. I don't know.
No doubt.
I think that's probably fair. But I
guess I would just the size of the balance sheet, though. Isn't it still more than $6 trillion?
$6 trillion, but it's about 20% of GDP. You remember, it's related to the size of the economy, and it was 40% of GDP at the peaks.
At the peak, it was more than $9 trillion, but before 2008, it was $1 trillion.
Well, and that was before we went to this ample reserves kind of more highly regulated structure, where I think I would kind of put a neutral balance sheet at where we were in 2019, when we had rates at about 2%. Flat, yield curve at 2, and the balance sheet was 20% of GDP. The unemployment rate was 3.5. Inflation was 1.6.
We just never get back to these being out of these emergency contingencies where the Fed is doing so much to keep things afloat.
I mean, we've got those great tools if we need them, Becky, and I'm more than excited to use them if they need to be used. But the point is, if we go back to 2019, I don't want to go back to 2008 because the structure of the market's changed so much. That was a neutral place. There were no rate hikes, no rate cuts priced in. We were sitting at a 2% yield curve flat. We had a balance sheet at 20% of GDP, no QE, no QT. It was about as neutral as it could get, with the Fed at its mandate. Full employment at 3.5 and price stability at inflation under 1. That's a good spot. That's the place we should be looking to get back to. The balance sheet is back at 20% of GDP, within spitting distance.
Let me ask you, though, to think
rates
about...
Rates are not at 2.
Unemployment versus inflation.
Yeah.
Tariffs, how you think about the tariff piece. There's a view that it could be a one-time thing, and maybe it is, but it's probably a rolling one-time thing, meaning you're not going to see the inflation all happen in a month or two. It'll roll because people are going to adjust, and that adjustment could take 6 months, could take a year. I don't know. And so how you think about that up against the employment piece?
I've been in a unique position in my discussions of the tariffs with clients and in public as well, just saying I don't think it's nearly as big a deal as everybody's made it out to be. I thought it was a very tactical set of moves that the president made, sort of game theory, classic art of the deal, go in, go big, and then kind of drive it all back a little bit and get to where you ultimately wanted to be. And I think that's largely been the case. We've had a tactical move to get to 10 to 20, maybe 30% tariffs in some cases. I very much stand with the Treasury Secretary in thinking these are one-off price level shifts, and you have to look at inflation expectations and say, is something happening with inflation expectations where people think this is going to continue to metastasize? And the reality, Andrew, is it's just not there. The break-even inflation data, and even now the survey data, which I think became very noisy because of political division, that's come back down. So I feel like anchored inflation expectations, which really is, I think, the number one goal of the central bank, anchoring long-run inflation expectations, we're just anchored. You look at 5-year break-evens, you look at 10-year break-evens, you look at any of these TIPS measures, and you look at the survey data, but it never even got de-anchored when we went to 9%, and certainly the tariffs aren't de-anchoring them today.
But David, you think full employment is 3.5%? Because most people would say it's between
might even be lower,
5%.
I might
even
be lower.
With AI coming in?
I think
because if that's the case, you're going to focus on the unemployment side of things far more than the inflation. If you're willing to say 1 to 3% is okay for inflation, but you need 3.5% lower.
I think it's more the technology story. I think it really is like what we saw in the 90s, which is we were able to bring more and more people into the labor force in various ways without creating a lot of inflation because we had that tailwind of technological advance driving disinflation.
You don't think AI is going to put people out of work, that it eventually brings more people back in?
It'll displace many existing jobs, create opportunities in other places, and we may be seeing people move from one set of careers to more, desk jobs to vocational
Seems
jobs,
different.
and we're already seeing
different this
anything.
time than
Well, it seems like the 90s to me.
It does.
I like
but
the
it
90s.
seems
I like the
di-
90s story.
It seems different this time that this is more. This is not just a Luddite moment where you go from buggy whips to automobiles, but this it could do everything. And we go to UBI. We don't go because we're all fat and not working.
Maybe in this city.
Let me ask you a different question. I think you know that most of the people on the board of the Fed today, and I think most economists, talk about the independence and importance of the independence of the Fed. And they want to know that the person who's leading it is full-on independent. That's what they want. That may not be the reality. And the question is, do you feel like you can be fully independent, given your relationship with the Treasury Secretary, given your relationship with the President, if in fact you have a view that is at odds with the President of the United States?
Well, let's go to exactly what you said, that this ideal of independence. The reality is the Fed is not independent. The Fed has never been independent, and the political pressures on the Fed have always been growing and continue to grow, whether it's letters from Maxine Waters or Elizabeth Warren pounding on the Fed to be cutting rates around election times, which was continuously happening, and Sherrod Brown when he was there, or behind the scenes movements by Treasury secretaries trying to influence Fed chairs or administrations. All of that is there, and recognizing that is actually a critical feature of being a good fiduciary and being a good investor. One of the things I do at Jefferies is try to help our clients understand the Fed reaction function. Politics is in the Fed reaction function.
I'm not disagreeing with you that politics is in the reaction function at all. What I'm asking is something slightly different. I think we can empirically look at Jay Powell, who was put in the role by this president, and he is now clearly at odds in terms of his opinion of the universe and how the economy should be managed with the president.
Yes.
So by default, you would look at Jay Powell and say, there is somebody who's independent. You may think he's wrong.
Actually, I disagree with that. I think he's actually quite a bit dependent, and he's dependent from the other side of the equation. Right. He's operating politically from the left.
Okay.
Let's put it this way, from the anti-Trump side of the equation.
Sure, whatever it is, but my point is you would look at him and you'd say he is independent from the president, in that he is not doing what the president is telling him to do, correct? You were with me.
From the president, but not from politics. Politics, what drove the September rate cut of 50 basis points? Was that political?
I think what I'm asking you is slightly different.
Yeah.
What I'm asking you is, if the president says to you, hey, I need you to do X, Y, Z, do you feel that you can say on TV right now that if you actually in your own brain are an independent human being and disagree with the president, that you can go out publicly and say, you know what, I'm not doing that because I don't think that's the right thing for the economy?
I think you would take into account, Andrew, all of the political pressures that come from Congress, that come from the administration, that come from all of the variety of sources that they come from, and you make a decision which is going to be consistent with the goal of the institution, which is maximum employment, price stability, and making sure inflation expectations are anchored. If the president is saying something that you agree with, you shouldn't just fight with him because you want to look at it and say, I'm potentially not independent because I'm agreeing with the president or a congressman.
I think we can agree from a perception of independence perspective that it is not helpful. I think you agree with this. It is not helpful for the president to be publicly espousing particular views about the Fed because it, in fact, puts whoever's in that seat in a much more complicated position to actually have credibility with the marketplace.
I don't even know if I would go there. I think if the president would like to say things about interest rates and discuss them openly in public, he should be able to do so. He has views that I think are interesting and actually have been in many ways correct. What he was arguing in 2018 and 17, for example, turned out to be entirely correct.
I understand that, but do you believe the marketplace cares whether the person who's in this job is considered a puppet or not?
I think that if you are going to be in this world of politics in Washington, D.C., you're going to have influences coming at you from every direction, managing those.
But Trump.
I'm not saying it's about Trump.
But Trump. But Trump.
You know, you do.
Don't you understand? Trump.
You do a good impression, Joe. You do a good impression.
Thank you.
I think at the end of the day, you're going to manage all of the political forces that come through.
By the way, this is not even about Trump. It's just about the job.
Okay.
This is.
He just told you that he thinks that Powell is totally biased based on his left.
Or his, I don't want to say. I think he's.
Did you ever hear
a pro deregulation guy?
Did you ever hear a word from Powell about what happened during the early part of the Biden administration in the spending in what we were doing? And yet, he immediately, no, he didn't.
Yes,
he immediately weighed in.
Hold on,
tariffs.
David, if you want to be an intellectually honest guy, explain to Joe what you looked at all the things that Jay Powell said.
I will say one thing, and I'll give Andrew a little bit of a rope on this.
Make
one.
it small.
Right, which is, the chairman did push back on a lot of really crazy
pandemic
stuff
stimulus
from the regulatory side of the equation.
I'm
Michael Barr, what he was doing.
I'm talking about what engendered the inflation.
Yeah, he
stayed at zero. And he stayed at zero and didn't say a word.
Okay, I'm going to give him the regulation and the woke stuff. I think he pushed back on both of those.
All right, that's different. That's not what I'm talking about.
I'm talking about what you're talking. That's why I said I'm going to give him a little bit of rope. I'm not giving him all of it.
Talking about the $5 trillion that both Trump and Biden spent.
I think he stayed out of the fiscal debate.
He did until tariffs.
And then tariffs came along, and he entered into.
Oh my God! Now we got to worry about after you let inflation go to 9%. Now you've got religion on tariffs with 2.7%.
As you said earlier, Joe, economics is not a science.
No.
It's an art, and they're trying to put too much precision.
It's almost a pseudoscience.
Yeah, it could be voodoo as well sometimes. But
look who wins Nobel Prizes. They have diametrically opposed opinions. They both win because there's no answer. There's nothing that's true.
It makes it a great field. It's like the market. I mean, it's the puzzle you can never solve, which I love. I love the whole field. I've been a passionate student of both economics and the markets all my career. I go back and I think the Powell Fed has had some pushback. Some legitimate pushback on the administration in areas where it went way over the edge. I give him that. But I think Joe is absolutely right that this is an administration that did not fight back on some of the worst Biden policies. And that's come back to bite us.
David, early in the discussion, you said that you would like to be able to go in and be able to make your case to the Fed, to the recognition that the FOMC is not run by one person.
That's an important point, Becky.
You have to build a consensus. That's an important part of the job. What do you think about the people who are at the Federal Reserve, particularly the voting members of the FOMC right now? How do you think you would go about that? Do you have a relationship with any of them?
Well, I've been at the Federal Reserve twice in my career. I spent all of 2009 there as a visiting advisor to the board, and I started my career 34 years ago. I walked through the C Street entrance of the Eccles building, which is now under deep construction, into the beautiful foyer that they're fixing up, and started my career as a summer research associate. So I have a lot of deep history with the institution. I know a lot of staff members and ex-staff members, and I think I've got a pretty good understanding of the place, and I think in terms of coming to a view and coalescing around a view, I do think people are open to listening to alternatives and looking at what has happened in the course of this post-pandemic period. You have to put the puzzle pieces together. 2023, you would have every economist come through and sit here and tell you a recession is coming. The Fed had raised rates 400 plus basis points going to 5.25. We were going to get a recession with almost 100% probability, the street economists. And I said something very different. I said, you know what? This balance sheet's so big and it's exerting so much stimulus into the system that 500 doesn't feel like 500. 500 feels like 200 or 300. And we're not going to get a recession. It's actually not restrictive monetary policy. That argument, I think, holds the test of time. And it's part and parcel the argument I have today, which says that we got lulled into this false sense that high rates don't hurt us because of the balance sheet. Now the balance sheet's back down. Now they can kind of hurt us.
Then you don't need to cut as much because
no, you do because these rates are way too high back.
Yeah, but if those rates
4.25 is way too high.
It was all about the balance sheet, and the balance sheet is fixed now. You don't need to cut as much because every one of those cuts would be felt more impactfully.
No, they will be more impactful, but you have them at a very high level. They're way above neutral. If I'm making the argument that we're going back to a 2019 style neutral level, we're 200 plus basis points above neutral. That's a lot.
Right.
So I think that's where the starting point is. You're not going to have anyone, no one can go in on day one in that committee and sit at that board table and go, we're cutting 200 basis points. It's impossible to do. It's impossible. You have to go intellectually in there and have a debate and coalesce a committee with a lot of different views around this idea that policy is quite restrictive. And that's the answer to Andrew's question, is how would you approach it? I think that's the way you have to approach it, because there's no dictatorial structure. There's a lot of separation of powers across districts and presidents and governors. That said, 4 seats on the board will be controlled by...
We didn't mention it, but so Bloomberg's writing it up that Bill Pulte is saying, who is the director of federal housing, that Lisa Cook has mortgage issues. And whether that, and so it might be maybe more than 4.
It might be.
I don't know. We'll see what comes of that. How come we haven't talked about that here?
I've been longer story. I've been going back and forth with you.
Okay. David, thank you. Appreciate it.
Always a pleasure.
Great to see you, sir.
That is Squawk Pod for today. Thanks for listening. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern and get the smartest takes and analysis from our TV show, all 3 hours of it, right into your ears in a podcast when you follow Squawk Pod wherever you like to listen. We'll meet you right back here tomorrow.
We are clear. Thanks, guys.